Hey folks, welcome back to this edition of Ben's Bits. There's been a lot of chatter about the last few bits in a good way. It seems the vast majority of you understand where we're coming from and why we approach investing the way we do, and are starting to fully understand why our outlook on traditional investing is an outdated method. We did have one great question that came about when talking to one of our clients. It was rather a request to talk about how rehabs affect the discussion and if there was an alternative with that particular vehicle. And I thought we'd pick it up in this bit because I'm sure some of you have had similar thoughts or opinions. In short, but we'll elaborate here in a minute. However, the short answer is it doesn't affect the approach we take because we still want to deploy our capital into an investment vehicle that accelerates the time frame or has a higher return. That's the short, obvious answer. Now, to further define what that specifically means in relation to rehabs, it's just a basic math versus risk equation, right? Where we weigh the potential reward against what's going on in the market. We actually have a strategy we use called a brawling badger that we'll be releasing in the near future that will cover the overall technical aspects in a greater detail. In fact, we were going to be making two others first, but we decided to fast track it due to that conversation in this bit. But back to the point at hand, how do rehabs affect our approach to investing? Rehabs have a place in the investing world, but in talking to many investors across the country, it's becoming extremely rare to find assets that rehabbers can turn a profit because HGTV has many people thinking it's easy and a quick money grab. Then they find out quickly the truth. But if your target is to acquire large lump sums, non performing loans are a better way to go, in our opinion, because there's more profit typically and less work involved. In fact, most of the time, you don't even need to deal with vendors or contractors. And it's a great strategy for those of you who like more profit with less stress, because when this is executed correctly, you can use a workout company to do all of the work and they do it for you. And after you give them their instructions, of course. And depending on your tolerance levels, you can choose states that have a shorter foreclosure time frame to move the process along at a faster pace. Now, we'd really just prefer the homeowner catch up on payments or agree to a workout schedule because, as those of you who have been following us for a while have heard us say multiple times, we don't really want the house. That's just one factor or one side of the coin. It's just the collateral that we bought at a discount. And when it seasons, you can keep the monthly payments coming in every month. You can sell it. You can take the large lump sum payout. All in all, it's a much better route, in our opinion, because it has a higher ceiling and more potential payoff than rehabs do. So, for those of you in the rehab space, first, I'm sorry you're going gray because of the stress, just bringing a little levity to your situation. But for those of you in the rehab space, you understand the math behind it. You're not finding assets that are 40, 60% on the dollar. From what I'm hearing from investors in that space, even from the bigger players, you're not finding anything under 85 to 90%. Maybe a few of you are, you're finding one here or there, but that math doesn't work. And why would you want to go through all that stress when you don't have to? So that's it for this edition of Ben's Bits. And as always, thanks for watching, and we'll see you next time.